Hello folks, Scott here, and this is the wrap for Friday, July 19th. So it's 4:05 Eastern Time, about 10 minutes left in the futures session. The cash session has closed, and it looks like we're going to end up with an inside day where it's very close. But an inside day is a higher low and a lower high. It shows up on, maybe easier to see on a daily chart like this. See the high is very close. We may be covering right into the close. We'll see. It's very close. That'll show up in the worksheet that we share with our members in the morning for analysis. So that's neither here nor there. Monday is going to be Monday post options expiration week. That'll also show up in our member worksheet. But I thought I'd add a little nuance here. In fact, speaking of which, the worksheet won't be posted until Sunday afternoon or evening when I return from a family church camping trip. We're going to have a lot of fun. The whole family's going. And we have to leave here in just a few minutes. So I'm not going to be able to post the worksheet until Sunday. But you'll have plenty of time to prepare for Monday per normal. But what I want to show you in the meantime is are the results of fading gaps after you have put in a 20-day high close in one of the 3 prior days, the last 3 days of options expiration week. So it looks like clearly it's going to be today, but when you put in a 20-day high close, what happens during options expiration week? What happens on Monday? All right. And let me use Gap Trader, my back testing tool. Yep, it's no longer an inside day. We just broke through the highs there a little bit. And there you go. Odds favor a gap down a little bit more than a gap up. Terribly small sample size, so I wouldn't read too much into that. But what is clear is that using an end of the day stop, almost all of the up gaps have filled, and down gaps have been, actually that's a lower than normal win rate. Now again, sample size is terrible, but on the surface could be a little bit of extra risk for a down gap. Certainly not as favorable as an up gap, and that's what we know. So I will defer to our gap guides and my other research before I make a decision, but we may have a decent fadeable gap on an up gap on a Monday, which is a little bit unusual, but conditions may be ripe to capture a little profit taking to the short side. Okay. Now today I actually did a money show event presentation, was prepared to do some live trading, and was going to show people my account or one of my accounts making money or losing money based upon the gap and range trades, and unfortunately we didn't end up with a darn gap. So in fact, let me show that to you. Let me show you my 5-minute chart. You can't even tell it, but the open was 1680.75, the exact same thing as the 415 close, the last trade as of yesterday. So we ended up with nominal gaps. Russell was slightly up. Let's see, the NASDAQ was slightly down. Dow was slightly down. So no gap to speak of. Let me just show you. I'm not going to show you I'll show you the worksheet. You can take a quick glance just so you know what I'm talking about if you're new to our mail list. Today's gap play worksheet. Shorting an up gap is what I was hoping for today. That would have been a very good historical setup based upon a number of parameters. You can see our gap guides. This is the average of all 8 gap guides. We're very favorable for shorting an up gap. OPEX Friday is favorable for shorting an up gap. After an unfilled up gap, favorable. Inverted hammer, okay. Let me show you my pre-market comments. But a down gap was problematic. You see that here after an inverted hammer or on options expiration Friday, or even opening below the lows, which is what I thought we were going to do, but we rallied right into the open. Lots of concerns for a down gap, but really few for an up gap. I'll let you read this other research. This was last night's video. 2 consecutive unfilled up gaps. OPEX Friday after a 20-day high close. Lots of strong numbers. And because I was doing this money show event, I had to post this at 8:45 Eastern Time today. So I had to prepare for different contingencies, opening up or down. And bottom line, I just said that I will not fade a gap down today, but will fade a gap that opens above 1685. Now I want to explain what I mean by that. 1685 meant I was only going to go short today in the ES, which is what you're looking here, the S&P 500 futures, if the ES opened above this level right there, which was the 4 o'clock closing price, where in a relative sense the ETFs closed. Right? This is where the spider closed yesterday. The dump here was Google earnings, blew it out, or in the wrong direction, I'd say. They really missed terribly, and we closed down 4 points. Very unusual, or fairly unusual, I should say. So this creates what I call closing variance. A 415 closing price is one closing price target some gap traders use. The ETF traders, however, were targeting the 4 o'clock price. In fact, you can see the futures got up there, the markets reversed. See that? That would have been a good fade to fill opportunity. See, you can see how went up, filled the blue line, and then reversed. So, but there was no joy for me. I just left the gaps alone. I did show some analysis at the Money Show event this morning that showed that options expiration day tends to be fairly binary. If you're trading above the open, it tends to rally higher throughout the day. If you're below the open, it tends to sell off. And sure enough, today we traded, got above the open, and just kept on grinding all the way into the end of the day. Now, none of the range trades were attractive. It was a very mixed or neutral setup. That's just the way the numbers played out today. There were no high breakouts, low breakouts, high fades, or low fades that looked good. The only historical data I had that had any real clear direction bias was historically high fades and low breakouts have worked the best. That was not the case today. This is just an extraordinarily bullish market. A high fade would have been going short here. Now, I didn't have the technical range guides didn't favor the high fade, so it was an easy pass, neither the 15-minute nor the first hour. So I didn't do it. And I don't know anyone that did, but it just shows how bullish this market is, because options expiration day has some strong, consistent pressures historically, and they just got overwhelmed by the bulls today. So amazing action here. It's probably going to end with a big ugly swoop sell-off at some point. Maybe we'll rally and throughout all the summer, but I doubt it. I think we'll probably have a September, October, maybe an August pullback. Could get pretty ugly and probably be a good buying opportunity, quite frankly, but I'm way ahead of myself. And those are my thoughts. So that was today, and we'll see what next week brings us. And that is the wrap for Friday, July 19th. Have a great one.